So today we'll talk about Wag Group, a company listed on Nasdaq under the ticker PAT. PAT. You know, I got really tempted when I took a first look at this company because it indeed seems really cheap, and the upside potential also looks huge. Really, if things go right here, this stock can be a multi-bagger, going up like 20 times. But even so, I decided not to invest on it, at least not yet, and today I will explain why. But before we begin, as always, nothing in this video is investment advice, okay? But you see, Wag Group really got my attention, first because of its business model, which I really like. In case you don't know, this company, Wag Group, operates as a pet marketplace, connecting pet owners on one side and service providers on the other. For example, let's say you have a dog and that you need someone to walk with it. Well, you can open the Wag app and there you will have a bunch of people available to walk your pet. Besides, the company also owns websites like Dog Food Advisor and Cat Food Advisor. So in summary, Wag Group offers a one-stop shop for pet owners. Now, the first thing I like about this business model is that it is highly scalable and it is also capital light. On top of that, there's also a network effect at play here because the more pet owners join, the more pet service providers get attracted and vice versa, which creates a virtuous and self-reinforcing growth cycle. So that's what first got my attention. The second thing that caught my eye was Wag Group's high gross margin, currently at almost 80% as we see here. That is a very good gross margin. And having a gross margin like this is key because the higher it is, the more you will have to cover your operating costs. So if you run your business efficiently, you can gain a lot of operating leverage, keeping more in profits. That's why companies with a high gross margin are more likely to become major cash generators because they simply start off strong. But I remember that when I saw Wag Group for the first time, I thought, man, I must really pay attention here because companies like this, super scalable and with this kind of margin, are usually traded at very high multiples. For instance, I can easily imagine a business like Wag Group trading at 5 times revenue, even at 10 times in good market conditions. Now, considering that Wag Group's annual revenue stands at around $77 million today, if it traded at 5 times revenue, this company's market cap could reach almost $400 million. Now, do you know where Wag Group's market cap stands today? At only 15 million. In other words, this company is trading at only 0.2 times revenue. So that's why I said the upside potential here can be huge because from 15 million to almost 400 million, that's more than 20 times. Now, of course, there must be a reason for this company to be trading at such a ridiculous level, right? Yes, there is. You see, Wag Group has only been losing money over the years. As we see here, not a single year of operating profit and only negative cash flows. But the most concerning is not that, but the fact that the company is running out of time to solve its profitability problem. Now, what do I mean? If we look at its balance sheet, we'll see that the current portion of its long-term debt stands at 19 million, while the company had only about 8.4 million in cash at the end of September. So definitely much more debt than cash. And this debt matures in August, so there's not much time left. And if Wag Group is burning cash, this means that not only do they need money to pay off the debt, but they also need cash to keep the business running until it becomes self-sustaining. So that's why the market is pricing this company at so low valuation levels. Because Wag Group is simply running out of cash. But it's precisely in bad times that great opportunities appear. If Wag Group manages to fix its business, stop burning cash and solve its debt issues, this stock could be strongly repriced. But if that happens, Wag Group might become a good and healthy company positioned in a high-growing market. After all, as having a child has become something very expensive today, everyone is becoming a pet parent. So there will certainly be space for Wag Group. But here's my reasoning, here's my rationale for avoiding this stock for now. So let's start with the cash burn. So Last quarter, Wag Group delivered an operating cash flow of negative $3.3 million. Some might say that that's fixable, that that's not a huge cash burn, but when we consider that Wag Group had only $13 million on revenue in the same period, I mean, it's a considerable cash burn. It's an operating cash flow margin of about negative 25%, so it's certainly considerable. Now, you can say that the company will fix that. After all, for instance, we are seeing cost-cutting initiatives from the company. As we read here, Wag Group has been reducing its headcount. Only on the third quarter, they've reduced it by 12.5%. And by the way, this platform I'm using is called Seeking Alpha. Link with a discount in the description. But of course, this initiative might help the company to achieve break-even. Besides, Wag Group also has been cutting marketing expenses from $12 million in 2023 to $8.8 million in the third quarter of 2024. The problem is that cutting marketing ends up leading to fewer sales, as we see here. So if marketing expenses went down by 30%, revenue went down almost 40% when compared to the same period last year. So though some might say that Wag Group will be able to fix the cash burn, what I see here is a very difficult situation. Now, one important thing to note here is that this drop in sales wasn't just due to lower marketing spending. Wag Group was also shaken by the change that happened in Google. Now, when you search for something, Google gives you a direct answer from its AI right away. So for Wag Group, this means less traffic to its websites and thus fewer sales. And here I would like to add an observation. If the company's business was so affected by Google's change, if an external factor like this had such a big impact, can we really say this is a strong and solid business? Honestly, I think this highlights a weakness. Anyway, my point is, though I believe this company can eventually reach profitability, I don't think that is likely to happen in the short term. The problem is that it needs to happen in the short term, otherwise they will need to raise money from somewhere. Actually, as we can see here, Wag Group's share count has already been going up from 38 million shares to 47 million, which represents a 23% increase. So they are already diluting shareholders to fund themselves. And of course, this can be a way to solve the debt problem through dilution. But as you can imagine, I'm not interested on that, right? And at these price levels, it would take a massive dilution to solve this company's liquidity problem. Now, another way for Wag Group to raise capital would be through the sale of some of its assets, which, as we can read here, is what they seem to be planning to do. But this would be an effective way to handle the debt. And these are the assets Wag Group is thinking about selling: Dog Food Advisor and Cat Food Advisor. The question is, how much can these assets be worth? How much can the company get for them? For instance, Dog Food Advisor was bought in the beginning of 2023 for $9 million. Now, let's say Wag Group manages to sell it for twice the price it has paid. So, for $18 million. In this kind of market, that would be a wonderful transaction. So let's say that happens, okay? If that was the case, the company could indeed wipe out the debt, yes, while still keeping some cash, and then the only thing left to do would be to manage the operation so the cash burn stops. But you know, I think that $18 million might be a very optimistic assumption in this market we are seeing today. So that's why I decided to not invest on this company. Yes, this can become indeed an incredible business, but first it needs to solve its debt and get to the green. But the problem is that the clock is ticking. Besides, though I think this business model is a good one, at the same time, I don't see any serious competitive advantage in Wag Group. And lastly, I'm not buying this company because there are just too many good and cheap stocks out there for me to decide to take risk here. On the other hand, I would definitely keep it on my watch list and certainly want to see their next results. Anyway, that's it for today, and see you next time.